Thanks for attending the 2019 January MIF conference. Hopefully you'll hear some good talks or information today that helps you in your decision making within your own investment portfolios. My name is Greg McCoach, editor of the Mining Speculator, and I really enjoy this venue. It's good to see everybody. We had a good group of people yesterday, good attendance. Usually you get a slightly different crowd from the weekday to the weekend, and so glad you guys are here. So I've been showing this in the last few talks I've done only because it's from Gullivers Travels. You know the story of Gulliver being tied down by all the little people, and he wakes up and he's like, what's going on, right? And the reason I use this is because just in the last few months, I've been amazed by how many phone calls and emails I've been getting from long-term subscribers or clients that I have through Amerigold that are just kind of wanting to talk and just like, Greg, can you just let me talk a little bit and tell me what you think? You know, people are getting increasingly perplexed with what's going on. It seems to be getting more and more complicated, but as I always try to say to everybody, I said, you know, just oftentimes try to boil down all this information that seems to be very negative, boil it down into a simpler formula. And that's kind of what I've been saying lately. And we'll talk about that today in my talk. But I always like this quote from two perspectives. I always show this. It's on my website. Discovery consists of seeing what everybody has seen and thinking what nobody has thought. Albert Georgi, a Hungarian-born biochemist. Two perspectives. I like this particular quote because in our world of exploration, discovery often takes thinking out of the box to figure out the geological puzzles that make these big discoveries and make us money, the wealth-creating events that we're all looking for. And so I think oftentimes the best geos that I come across, the reason they make those discoveries is because they are thinking beyond what others have thought. Now, this second thing that applies with this quote, I think, is trying to discover what is really happening. How do we get to the bottom line on what is really the truth? Well, we all have opinions, right? Everybody's entitled to their opinion. I'll have mine today. You take it for what it's worth. But I sense that, you know, more and more sharp investors that I've been talking to just in recent months are suddenly getting very concerned with what they see. And so we move on. So my thesis for this year, 2019, the year gold breaks out. I think we're finally going to see gold get over 1,300. How much more it goes above that really depends on what I've been talking about, the catalyst. We need a catalyst for it to really get going, because at 1365, gold has a huge level of resistance. And for years now, gold has gotten over 1,300 several times, but just doesn't even seem to get close to the 1365 level. As soon as it starts inching up, it backs off and goes back down below 1,300. But if we get the catalyst this year, once 1365 is broken, there's no resistance till 1,700. And just imagine what that would do to our market in the mining shares, the gold mining shares. It would be phenomenal. We don't even really need that to get going, but we do need over 1,300. To get over 1,300, if we could start trading first part of this year in the 1,310 to 1,350 range, you know, kind of go back and forth like that, that would be very helpful for us. That would be a kicker to get us going. So this is what my contention is that gold's going to break out this year. How much, we don't know. If we get that catalyst, watch out, things could really get going. So trying to boil all this complication and all this analysis and data that we read about, you know, how to try to put it together, I just say ask ourselves some basic questions first. Number one, is market volatility going to increase, decrease, or stay the same this year? I think it's going to increase, greatly increase, not just increase, but greatly increase to the point where we could see some shocking developments. Second, will instability in the world increase, decrease, or stay the same? Same thing. I think instability in the world is going to increase. Will safe haven issues increase, decrease, or stay the same? Obviously, I think safe haven, the moves into safe haven as gold starts to ramp up are going to increase. So you're going to see more and more people moving into the sector because of those safe haven issues. And of course, what sectors will benefit based on those assumptions that you make for yourself, whether you agree or disagree with those three items. I think gold is the biggest beneficiary. It's the most undervalued of any market, really. The commodities in general, but specifically precious metals and mining shares. So for this year, even though in my view the fundamentals for the base metals still appear good, I think the big money is going to be made in precious metal mining shares this year. That's where I'm betting. So with all the volatility we saw in December in the general stock markets, just crazy volatility. That's very unusual for December to see that kind of market volatility, and I think it's a very telling sign. As many of you know, I've been following Graham Summers' basic thesis of how he looks at things, which has basically been my view for a long time. He just says it more eloquently than I ever have, and I give him credit for that when I use his quotes or things like that. But we believe the next leg down is about to begin in the general markets. Last week was options expiration week, Wall Street's favorite time to ramp the markets in order to ensure the maximum number of options contracts expire worthless. This and nothing else is why the markets rallied this week. Tweets from the president or some statement by the Fed official were simply the excuse Wall Street used to engage in this game. Wall Street's talking out both sides of their mouth. One week it's this, the next week it's that. What do you make of all that? Who knows? But I think this game is ending. The game that they've been playing is ending, and look at the reason why is because the S&P 500 large cap index is spelling it out. The resistance, it looks like we're hitting a major resistance level, and it looks like the next leg is going to be down. This is also true in the debt markets. It's a risk-off trade right now. You see the blue line, which represents the risk of debt, is moving down now. It looks like that's going to continue. And then you also see same thing with the transports. The blue line is moving in a downward direction. Home builders, same thing. Looks like the home building situation is coming to a quick close. I live down at Semiahmoo at the resort. I'm in a condo there. And they built all these duplexes on some land that was available. And when they first started, man, it was selling like hotcakes at record sales prices. But all of a sudden, it's all stopped. And they're caught with about 10 or 12 buildings that they can't sell. And I think they're going to take a bath on those because, I see this as I've been traveling. I'm doing a lot of traveling lately around the western United States, Arizona, Montana, Idaho, Washington, Colorado, and you see it everywhere. You see that the housing market is gone over the peak. Prices are headed lower, and all of a sudden builders who haven't sold their entire projects, I think, are going to get caught again. So for those with cash and looking to buy real estate, you're probably going to get a really good opportunity in those areas. We'll see. So you can ignore these internals that Graham Summers is talking about all you like, but what has actually changed since the end of December? Is the Fed going to start loosening monetary policy again? Is the economy suddenly going to start roaring again? Are earnings going to reverse and stop declining? Or are we actually at the end of the credit cycle and moving into the next crisis shortly? Graham, as well as I, both believe that we're coming to this next crisis level. I've certainly been wrong about trying to predict this. Nobody has a crystal ball. It's so hard, but you can see a lot of the information is coming together. And this is a decision that all of us have to make as investors for ourselves. What do we believe? What do we think, right? How this is going to go. S&P 500 large cap index, you can see that this is poised for a downward leg now, and I think this is just telltale signs of what what Graham's been talking about for over a year and a half now since I started reading him. If you don't know who he is, he wrote a book called The Everything Bubble, and it's $11. You can buy it on Amazon. Just Google it. It's a very worthwhile book to read. It's right in line with my thinking, and he's very eloquent in his presentation. So overall, my thesis has been basically mankind has been hurtling towards a disaster of its own making for quite some time. For almost 20 years now, I've been pointing out what I see as the unsustainable trends in society that now appear to be converging towards some terrible conclusion. I say these things not because I am fear-based or enjoy crisis, but simply because these are the times we live in, and we got to deal with it. And those of us who are awake to these realities, most of the people at this conference, need the best information in order to make informed decisions for ourselves. So, you know, these things, I'm just trying to make money out of this, right? I hope for the best always. I prepare for the worst. That's my motto. But unless the central banks reverse course immediately with what they've been doing, 2019, I believe, we'll see more stock market volatility, more bond losses, and falling real estate prices. Eventually, these credit stresses will impact those portions of the economy dependent on continuous access to the dumb money. Sooner or later, the illusion of prosperity created by all the dumb money these past 10 years is going to go by the wayside, and that's when we discover the ugly truth that there is no actual liquidity, only the appearance of such as temporarily provided by the computer algorithms. Yeah, it's just all these algorithms now. The fact is 85% of all trading is now done by algorithms or trading programs that automatically buy and sell based on preset inputs. The danger of that, you know, when times go bad, is just incredible how ugly that could get if it goes the wrong way. And even the Wall Street Journal last week wrote an article about it saying, you know, hey, this is a real concern. Although they're not concerned when the algorithms are trading the market up, all of a sudden it's a problem only when the markets are trading down. So in December, the U.S. stock market dropped more than it ever had, then went up more points than it ever had the next day, then swung up another 900 points in volatile fashion within the last hour of trading. This all happened within a 48-hour period. To me, this is just like a shot across the bow, a missile across our bow. It's something we need to pay attention to. It's telling you that something is wrong with these markets. And I've been saying this for quite some time. But again, it's so hard to predict the end game for this. So where are we in the current cycle? For the past 10 years, the Fed has continued to feed the dumb money, the quantitative easing, into the system, which has created all these asset bubbles. That's Graham's contention. That's how he describes it. And, you know, basically in that book, he says, look, the Fed keeps pushing this money into the system, trying to create this prosperity. But it's fake. It's really not real because in 1999, the tech bubble burst and crashed and cost a lot of investors a lot of money. I know several people that lost their retirement accounts in that, following the Wall Street model that they were told to follow with their retirement accounts. So then they reflated. They started another bubble called the real estate bubble, and that blew up in 2008. And then when that blew up, that was a real big problem, right? The system almost collapsed right there. But with massive amounts of money, and what they did then to get things going again, they created what's called the sovereign bond bubble. It's the mother of all bubbles. The numbers are simply staggering, how they've been able to reflate the economy to make it look like everything's fine. But I think we're getting to the point now where it's over. This game, this credit cycle, this massive amount of pushing money into the system is coming to an end. So every time there was a hint of a downturn, more juice has been pushed into the system to keep the patient alive. But then late in 2017, inflation started to rear its ugly head, and the Fed began removing the QE and raising interest rates. Okay? Well, this is all a huge problem for the Fed, because if they raise interest rates, the governments they serve can't pay the interest on the debt they have. And the debt is increasing in exponential levels, and we're all spending money way beyond what we're taking in. So of course that's not sustainable, but that's what we're doing. So now the Fed must either reverse course and push an ever-increasing amount of QE back into the system, or we're about to see major declines in all these asset bubbles. You pick. Which way do you think it's going to go? I think it's going to go negative, bad. The problem is this time around, it won't just be undervalued stock markets that take the hit. It will envelop everything bubble. All this money has created lots of asset bubbles. And the only bubble that hasn't been created is in the commodities, and particularly in the precious metals and the mining shares. So that is where your opportunity is. As a contrarian, that is where I see the biggest money is going to be made. You know, I made my name in this business when I first got started in 1998. I started a bullion dealership called Amerigold, and I was telling people to buy gold. $253 an ounce was the bottom. People were telling me, gold's never going over $300 an ounce. Greg, gold's never going over $400 an ounce. And they kept telling me that. And I kept telling, nope, buy gold, right? And of course, you know, by 2011, it hit 1950. Now we're back at 1200. I think the next big run is about to happen. This is just the start of it. And so I think we're getting very close. So gold is the retail investor's hedge against government and central bank instability, insanity, and less faith in our established institutions. From my perspective, I don't know why people give these people so much credit. I mean, it's just, it astonishes me how stupid some of these decisions are. And the joke, the Fed, when they get up and talk, they talk out both sides of their mouth. And I think, how can anybody make anything from that other than this is just fraudulent? They're committing fraud. But that's my take on it. The match, the catalyst that keep talking about it for the last couple of years, I've been talking about all these potential catalysts or black swans, if you want to call them. I have over 30 of them that I've been tracking and watching, you know, and some months, some of them come more into view than others, but I don't know what it's going to be, what the catalyst is going to be that breaks the camel's back, so to speak. It could be something we don't even know about yet, right? Just like, you know, in 2008, I was one of the guys talking about these problems, that something big was coming, and people laughed at me. And then all of a sudden it happened, and, well, you know the story. The difference, though, between 2008 and this period where I believe we're about to run was in 2008, the institutions had a boatload of our mining shares, and they owned gold, physical gold, and the quality mining shares. So when 2008 hit, it was a liquidity event. These institutions had to sell. They had to just blow everything out. And it hurt our market. We got slaughtered for the first 9 months right after that happened. This time around, the institutions don't own anywhere near the amount of shares they own now, or but from back then. They own some shares, but much, much less than before. And certainly investors, retail investors, don't own as many shares as they did back then. And certainly not that much physical. The physical metal, a lot of people have sold it, trying to raise cash the last several years to go into other markets or whatever. So again, the retail investor is without physical gold and doesn't have much exposure to mining shares. So this is the opportunity again, in my view. So I'm not a fear guy. Don't fear or worry about what you can't control. Most of this is out of our control, right? But look at this as an incredible opportunity and time to make some money. Concentrate on what you can control. You can own gold, you can own silver, the precious metals, you can own the quality mining shares, you can take a preparedness mindset. After that, all investors can do is get out of the way and let governments and central banks of the world commit economic suicide, because in my view, that's what they're doing. So the Fed is caught. It appears to me we're about to find out what happens when 40 plus years of excessive debt accumulation comes to an end. We have seen time and time again that central banks will do just about anything to avoid the consequences which they have created. They'll do anything. You know, they'll talk out both sides of their mouth. You know, just when their one thing doesn't work, they'll quickly switch gears. But it's all based on deception and fraud, in my view. And, you know, it can't end well. It's impossible for this. Every situation I've read about or looked into in history with the Fed doing what they're doing always ends badly. It's not 80% of the time, it's 100% of the time. So will they or can they kick the can down the road one more time, right? It's amazing to me that they've been able to get away with it this long. Even the Fed chairmen, several of them, Bernanke, Greenspan, have admitted that 2008, the world was this close to a Mad Max kind of deal, right? I mean, it was bad. They've even said so. They got through it. Okay, this next one, it's going to make 2008 look like a picnic. It's going to be, the numbers are much bigger, and there's no bailouts. So will they or can they kick the can? This is a decision you have to make for your investments. If you think they are going to be able to do it again, then we're going to get the reprieve, and gold's probably not going to do too much for this year. I think they're coming up against the limits of what they can do. So ultimately, this is the choice investors must decide for themselves. For trying to profit with the mining shares other than owning the physical metals and taking delivery of them, I'm very big in owning the physical metals and making sure you're in control of them. If you don't really control them or have them in your physical possession, you're probably not going to benefit from them, because things are going to get so dicey that, you know, there's probably going to be a lot of problems with ownership. But from the mining perspective, I say stick with the best discoveries. Buy the best discoveries while they're still cheap. You know, tax loss selling is over. We're seeing a gentle rise, not much, but you know, some of the better companies are rising slightly. They're still at incredibly good values, I think, for what I see coming. And you know, again, stick to the precious metals. As much as I like base metals as well, I just don't see that is the big profit opportunity here. Yeah, the fundamentals for copper and zinc look good with the growth model of the world, but why are they not performing? You know, they had dismal performance in 2018, and I think there's some changes coming. So, also, you know, I'm a big exploration guy. I love exploration. That's where we create the most wealth of any of the mining opportunities we have. Of course, it's hard to, you know, pick the right one, so you have to spread some money over the best ones you can find, hoping that one or two of them do exceptionally well. It doesn't really matter what happens to the other ones. You've done so well, you can overcome any losses you had on the other ones. But also, you know, buy the strongest development and production stories if you want less risk. Those definitely, you know, there's some real quality companies. Look at the new Newmont Goldcorp merger. This is what we've been talking about, that this is happening about last fall. Randgold and Barrick, you know, made the merger, and that's because these companies are under pressure. They're all, you know, drawing down the reserves very quickly and not replenishing them, and the institutions are looking to buy the highest quality, strongest balance sheet companies they can find. And so these mergers make sense for the majors right now. Will it trickle down into the juniors? I think so. I think that even mid-tier companies will have to start looking for cover if the gold market doesn't really get going, right? Precious metals, silver prices, if they don't start moving this year, we'll see more of that. But ultimately, it's good for our market. So buy the companies that are also trading at or near cash value. We saw several great opportunities in December there during tax loss selling. Some of them aren't quite as dramatic as they were. The prices have gone up a little bit. But these are just my thinking, my ideas for how we're going to make money from all this. So to subscribe to any of my letters, just go to www.discoverynexus.com. And thank you for listening. We'll move on now to our panelists here.